Hey everyone! Welcome back to Wealth for You, your friendly Kopi companion for understanding dividend investing in Singapore. Today, we're diving into OCBC's 3rd quarter 2025 results, which ended on 30th September 2025 and were released on the morning of 7th November 2025. In this video, we'll break down OCBC's performance, discuss whether it's fairly valued at $17.19, explore how the Fed's potential rate cuts into 2026 might impact its profits, and highlight what Singapore income investors should look out for. All in plain, Kopi shop language. Oh, and stay till the end for my final thoughts on how dividend investors can approach OCBC in today's market. And if you find this video useful, please like this video so more Singaporeans can watch and subscribe to Wealth for You, your weekly dose of financial wisdom, one Kopi at a time. All financial information presented in this video was downloaded directly from OCBC's official investor relations website and verified public market sources. The content is strictly for educational and informational purposes only and does not constitute financial advice, investment recommendation, or solicitation to buy or sell any securities. Viewers should always conduct their own due diligence or consult a licensed financial advisor before making investment decisions. Chapter 1. What is dividend investing? Before diving into the numbers, let's talk a bit about dividend investing. Dividend investing means buying shares in companies that pay out part of their profits to shareholders, just like how you'd collect Kopi money every few months without needing to work extra shifts. It's about building steady, recurring income, not chasing hype stocks that swing up and down faster than Kopi prices. In Singapore, strong local banks like DBS, UOB, and OCBC are favorites because they've proven track records of paying consistent dividends while staying profitable even in tough times. Chapter 2. The steady Kopio of Singapore banking. When you think of dependable Singapore banks, Overseas Chinese Banking Corporation, or OCBC, is right up there with DBS and UOB, the three pillars of our local banking scene. OCBC runs on three powerful engines that keep its profits brewing year after year. First, there's its banking business, which covers everything from loans and deposits to credit cards and day-to-day financial services. Next, its wealth management division, including private banking, insurance through Great Eastern, and investment products, serves both high-net-worth clients and everyday savers. And finally, its global markets and treasury arm, which manages trading, foreign exchange, and treasury operations across regions. With operations spanning Singapore, Malaysia, Indonesia, and Greater China, OCBC manages about 640 billion Singapore dollars in total assets. It's well known for being conservative, prudent, and well-capitalized, the kind of steady Kopi-o Kosong that keeps Singapore's financial system grounded, no matter how the global markets shake. Chapter 3. OCBC 3rd quarter of 2025 financials. The 3rd quarter of 2025 was a steady one for OCBC, showing how a well-diversified bank can keep its Kopi brewing strong even as interest margins cool. For the 3 months ending 30th September 2025, group net profit came in at 1.98 billion Singapore dollars, up 9% from the previous quarter and about flat year-on-year. Total income rose to $3.8 billion, a 7% quarter-on-quarter increase driven mainly by record non-interest earnings. OCBC's non-interest income reached an all-time high of $1.57 billion, up 24% from the last quarter, thanks to strong trading gains and insurance contributions from Great Eastern. Its wealth management business continued to shine, now contributing 43% of total income, up from 37% previously, with assets under management hitting $336 billion, another new record. Meanwhile, the net interest margin slipped slightly to 1.84% as loan yields adjusted downward faster than deposit costs. Operating expenses rose 9% quarter-on-quarter, mainly because of higher staffing and technology investments. A sign the bank is still spending to stay competitive in its digital push. On the balance sheet side, asset quality remained rock solid, with the non-performing loan ratio steady at 0.9% for the sixth quarter in a row. Credit costs were low at 16 basis points, while the CET1 capital ratio stood strong at 16.9%, comfortably above regulatory requirements. All that translated into a healthy return on equity of 13.4%, improving from 12.3% last quarter. In short, OCBC's third quarter results reflected resilience and balance, record fee and insurance income, stable credit quality, and a strong capital base. For dividend investors, it's the kind of performance that feels like a well-brewed kopi o, steady, satisfying, and reassuring. Chapter 4. Is OCBC cheap or expensive? Now that we've seen the numbers, let's talk about value. Is OCBC's current price a steal or already priced to perfection? At the closing price of $17.19 on 6th of November 2025, OCBC's market capitalization stood at about 76 to 77 billion Singapore dollars. That makes it one of the largest listed companies in Singapore. On valuation metrics, OCBC trades at a price-to-earnings ratio of around 10.3 times, meaning investors are paying about $10 for every dollar of earnings, which is pretty reasonable for a solid established bank. Its price-to-book ratio sits near 1.2 times, suggesting the market is valuing OCBC just slightly above its net asset value, a fair reflection of its strong fundamentals and consistent profitability. And with a return on equity of roughly 13.4%, OCBC continues to generate healthy returns for its shareholders. In other words, this isn't a clearance sale stock, but it's not overpriced either. At $17.19, OCBC appears fairly valued to slightly undervalued. Not the cheapest kopi on the menu, but definitely a well-brewed quality cup that justifies its price. For dividend investors, that balance of steady performance and reasonable valuation makes OCBC one of those comforting long-term holdings you wouldn't mind topping up occasionally, just like your daily morning brew. Chapter 5. Dividend Yield and Sustainability. Now let's talk about the kopi money, OCBC's dividends. At yesterday's 6th November 2025 closing share price of $17.19, OCBC offers a trailing dividend yield of around 5.3% and a forward yield of roughly 5.1 to 5.2%. That works out to about 88 cents per share in annual dividends, a comforting payout for long-term investors who love seeing steady income flow into their accounts. What makes this even more reassuring is OCBC's moderate payout ratio, hovering between 50 and 60%. In simple terms, the bank distributes about half of its profits as dividends and keeps the rest to grow its business and maintain a strong capital buffer. With a CET1 capital ratio of 16.9%, well above regulatory requirements, OCBC has plenty of room to keep rewarding shareholders while staying financially secure. Of course, dividend growth might not be dramatic in the near term. As margins come under pressure from lower interest rates, earnings may soften slightly. But given OCBC's diversified income sources, from wealth management and insurance to regional expansion, its dividend looks sustainable and stable. So for income investors, OCBC's dividend is like a reliable kopi subscription, not overly sweet, not overly strong, but consistent enough to keep your mornings and your portfolio feeling steady. Chapter 6. Future Prospects and Fed Outlook. Steady Growth in a Changing World. Looking ahead, OCBC isn't chasing flashy expansion or risky ventures. Instead, it's sticking to what it does best: steady growth, disciplined risk management, and dependable dividends. The bank's strategy revolves around four key pillars. First, It's doubling down on wealth management and insurance, expanding Great Eastern's reach and private banking services to capture Asia's rising wealth. These fee-based businesses bring recurring income that cushions profits when lending margins tighten. Second, OCBC continues to invest in technology and AI, upgrading its digital platforms and automation to boost efficiency and customer experience, essential to staying competitive against fintech challengers. Third, it's strengthening its regional footprint across ASEAN and Greater China, tapping into growing trade and rising household wealth for long-term, sustainable growth. And finally, OCBC remains committed to balance sheet strength, keeping capital ratios high, costs disciplined, and asset quality solid. Management still guides for steady rather than spectacular growth, mid-single-digit loan expansion, slightly softer net interest income, and NIM around 1.9%. It's like a slow brew kopi, not instant excitement, but consistent warmth and flavor. Now the big question everyone's asking: how will the Fed's expected rate cuts into 2026 affect OCBC? If rate cuts are gradual and the global economy holds steady, OCBC could actually benefit. Lower funding costs, stronger loan demand, and rising wealth management activity as investors search for yield. But if the Fed cuts too fast because the economy weakens, it could mean slower growth, narrower margins, and some pressure on dividends. In banking terms, that's like adding too much water to your kopi. Still drinkable, but not as rich. So, what's the outlook? Moderate, well-timed rate cuts would likely help OCBC manage costs and sustain income. Aggressive cuts triggered by a downturn could make things more challenging. The key is balance, just like the perfect kopi blend. With its diversified engines of banking, wealth, and insurance, OCBC looks well-placed to keep earnings and dividends steady through 2026, even as the global rate cycle shifts. Chapter 7. What Singapore income investors should consider. For Singapore income investors eyeing OCBC, it's not just about the dividend percentage. It's about understanding the ingredients that make those kopi money payouts sustainable. First, keep an eye on payout sustainability. OCBC's dividends depend on consistent earnings and a moderate payout ratio. When profits stay steady and management remains prudent, dividends can flow smoothly even in slower years. Second, watch the trend in net interest margins, or NIM. Shrinking margins mean the bank earns less from every dollar it lends out. If NIM stays under pressure from lower global rates, profits could soften, and that can influence future payouts. Third, check OCBC's capital strength. With a CET1 ratio comfortably above 15%, the bank has more than enough cushion to handle market shocks or loan losses. Strong capital means strong staying power, something dividend investors can sleep well on. Fourth, remember OCBC's diversified business model. Its wealth management and insurance arms, especially through Great Eastern, help smooth earnings when traditional lending slows. This mix of fee-based income and stable banking revenue is what keeps OCBC's kopi warm even in cold markets. And finally, stay aware of the macro picture. Fed rate cuts, regional growth trends, and Singapore's own economic cycle all play a part in determining how profitable banks can be. Dividends don't exist in a vacuum. They're brewed from the same beans that shape the broader economy. So for dividend investors, OCBC is like that dependable kopi shop you visit every morning. Familiar, steady, and comforting, as long as you know how it runs its business. Final thoughts. OCBC's third quarter 2025 results show a resilient and well-managed bank, one that continues to deliver consistent performance amid shifting interest rates and global uncertainty. At closing price of $17.19 on 6 November 2025, it looks fairly valued, offering about a 5% dividend yield. A comforting cup for income investors who appreciate steady Kopi money returns. It may not double your wealth overnight, but it might just keep your wallet warm, one payout at a time. If you found this breakdown useful, please like this video so more Singaporeans can learn and benefit from it, and subscribe to Wealth for You, where we make Singapore finance simple, relatable, and fun. And before you go, share your thoughts in the comments below. Do you think OCBC's 5% yield makes it a fair buy at $17.19? Or are you waiting for a pullback before topping up your Kopi Money bank stock? I'd love to hear your view.